Merck Co is an undervalued pharmaceutical company that I am interested in buying. In today's episode, we're going to look at the performance of this company. We're going to run through the usual income statement, their top line revenue, as well as their bottom line net income growth over the last few years. We're also going to look at the health of the company, their total cash versus their total debt, as well as their total return performance versus some well-known companies in the same essential industry, such as AstraZeneca, Pfizer, Johnson & Johnson. We'll also peek to see how the institutions are doing, whether they are buying or selling this company, as well as that all-important dividend safety score and some very strong financial supporting metrics for this company. And we will touch upon their earnings that have come out recently. And as always, we'll run them through our stock valuation model, getting to our intrinsic value, to find out how undervalued this company is and what is the acceptable buy price we are targeting with our margin of safety. Now, as we can see, it is down around 10% year to date, trading at around $100, right there towards its 52-week low. Now, it offers a yield of around 3%, and investors who have been holding this company over the last 10 years would be up a fairly decent 114%, considering it doesn't include those dividends reinvested. And we can see it did peak at around $120 over the last few months. So let's take a look, see whether this is a company that has some strong growth and whether we can see this yield on cost grow to double digits. Now, income statement, top line, we do like to see 3 to 7% growth year on year. December 2018, 42 billion reported on the top line. December 22, around 59 billion. So nice growth over the last 5 years. But on a more granular level, we do see some slight inconsistencies, with a decrease to 2019 before a small increase and then a rapid increase after those COVID years in 2021 and 2022. And the trailing 12 months does show us that it does look likely that their top line may have minimal growth from 2022, but we will analyze that when we see that. And we'll also look at the last 10 years percentage-wise increases shortly too. Now, bottom line net income, it's gone from around 6.2 billion in 2018 to around 14.5 billion. So that is some very, very strong growth on the bottom line over the last 5 years. But on a more granular level, we do see some inconsistencies again. It has increased in 2019 before dropping in 2020, before increasing again in 21, and then another increase in 2022. But do note, as we can see, based on the trailing 12 months, it looks like that bottom line may fall. But as always, we will analyze that. So top line and bottom line have both increased over the last 5 years, but we can see on the income statement, it is slightly inconsistent year on year. Now, quick health check, total cash versus total debt. December 2018, 8.8 billion of cash and short-term investments. Very minimal movement from their latest quarterly report at around 8.8, so roughly in line. Now, when we take a look at that total debt numerically and directionally, what we see, it has increased from 25 billion to around 35 billion. So whilst their cash position has remained the same, their total debt has increased quite substantially. So we'll analyze that net debt to EBITDA metric as well as that dividend safety. Now, companies in the pharmaceutical industry on a year-to-date basis with those dividends reinvested from that total return analysis, Merck Co are one of the middle performers of the industry, down around 8% year-to-date. Now, when we expand that analysis to the 5 years for these companies, what we can see is that Merck Co is up around 58.5%, actually the second best performing from those we have analysed, with AstraZeneca coming in marginally higher at 80%. Now, do remember, past performance is never an indicator for future, but we do add it into our analysis. Now, very quickly looking at the institutions, 75% institutional ownership, 23.81 billion shares sold by these institutions over the last 12 months. But we do note around 239 being bought in that same time period. As we can see, the majority of that was in Q2 of 2023. Otherwise, over the years, there isn't much movement by the institutions. It is one that they just do hold within their portfolio. So the institutions are liking this company and at this price point from Q2. So do bear in mind also that institutions and what they do isn't something we directly follow. We do also do our own due diligence. So dividend safety score, we will touch upon this, but before we do, let's take a quick look at their earnings, which they had for September 2023. Well, they beat on both the earnings per share, 195 expected, coming in at around 18 cents higher, so a nice positive surprise. And in terms of the top line, well, a 4.51% beat, so very positive to see. And when I've analysed this trend over the last few quarters, we actually see over the last 4 quarters, depicted by the green, they actually beat on both the earnings per share and top line every single time. So that is very positive to see in any company. And a quick analysis of September 2023 versus September 2022. They did beat on the top line 6.7% higher, significantly higher on the year-to-year net income, as well as the earnings per share, bottom line margin, and operating income. So very, very strong. It is a growing company based on this data. Now, dividend safety score 99, the highest score that one company can obtain. Market cap 254 billion, so it is a mega cap company. Now, looking at some very quick recessionary metrics, they maintained the dividend during the 07-09 recession. Negative 4% sales, above the average growth of companies in the S&P 500, and they had a near essential return to the S&P of negative 57 versus the S&P 500's negative 55. Now, a nice increase, in fact, something that was just come out yesterday, 5.5% increase for the dividends. It is above that 4% minimum that I advocate on the channel, keeping it in line with inflation, so that is good to see. Last 5 years, 8% year on year on average, again positive. Last 20 years, slightly more of an issue, 3%, it is below inflation. But looking at the most recent data, I would like to see between 6 to 8% as a minimum going forwards. Now, they have been paying dividends increasing year on year for the last 11 years. And when we take a look at dividend yield theory, which states a company is undervalued when the current yield sits above the 5-year average, we can see some signs of reasonable / undervaluation based on this model. But as always, we never look at any of these models in isolation and draw conclusions towards the end of the episode. Now, forward PE 16, so slightly higher than the 5-year average of 14. And when we compare it to the sector PE, it is roughly in line at Merck 16.1, healthcare 16.2. And while it is trading towards the 52-week low, do bear in mind 52-week low is never a sign of undervaluation. Earnings data, it is susceptible to manipulation by management through accounting, so let's focus on the free cash flow payout. Below 60% is my personal target, as it does mean, in my opinion, that management can offer those double-digit increases we love to see as investors. Now, for the large part, it has been around that 60% or lower. We do see 3 years, 2014, 17, 2020, where in my opinion are slight red flag indicators where they are paying out more in dividends and they're generating free cash flow. But over the large period, it does seem to be under control, with 2020 at 48%, 2023 expected to be around 50%. So that is positive to see. Free cash flow, 341 in 2013, 581 in 2022. So it is increasing, it is moving in the right direction, and it is expected to increase in 2023. But again, just do bear in mind the inconsistencies that we do see with some years going up and some years going down. So just understand what type of company you are investing. Now, from 2013 to essentially 2019, the company hasn't had the greatest sales growth over that period. But from 2020 onwards, we do see between that 3 to 7% that I target, along with double digits over the last 2 years. So they are starting to grow at a quicker rate than they did from the 2013 to 19 period. So numerically, what this essentially means, the top line has gone from 44 billion in 2013 to 59 billion in 2022. So again, just understand the type of company. This isn't one that is fast growing every single year. What is nice to see is that they do share buybacks, as we can see these shares outstanding decreasing from 3 billion to 2.54. So they are returning excess cash to investor pockets. ROIC, remember, above 10% is what we're targeting. Does mean management are able to effectively allocate their capital. And it is above 10% every single year, with the last 2 years looking at some strong figures. So again, very positive in terms of management, the way the company is run. And nothing really much to say on the operating margin or the free cash flow margin, as we see both are well above the minimums that we target on both the 12% operating margin and the 5% free cash flow margin. Finally, one thing that does link into that very, very strong dividend safety is the net debt to earnings before interest, tax, depreciation, amortization. The net debt to EBITDA, where we look for below 3, and these numbers signal the number of years it would take the company to pay off all of their debt net of cash on hand. And we can see that in 2022, 0.7, well below 1, and in 2023 it is expected to go a little higher, but still well below that 3. So that dividend just below 3% is fairly safe, or very safe in fact, for Merck Co, based on the data we have. Now, as always, if you do enjoy the content, value is being provided, do smash that like button. It does really help the channel grow, push the content out to more investors. And do subscribe and hit the bell so you are continually notified of these videos as they drop on your doorstep every single day. And finally, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or wish list, do click on that pinned comment below. Now, jumping straight into the first model, we have Graham's valuation formula. So we have the stock ticker symbol, the earnings per share, growth rate per analyst estimates, and the current yield on AAA corporate bonds. Now, for two reasons, we won't be incorporating this into our final calculator. The reason for this, the first reason, is that their earnings per share has dropped dramatically from 2022, where it was above 5. So you could argue that some of this data is going to be skewed. However, some people may argue that given that is the latest earnings per share, it is one we should use. And also over the last few years, they have had double-digit increases on their top line. So if this is the way the company is to go, this could be one not to use. But again, I will show you the numbers so you can use it in your own calculator if you want to. So this comes to 6860. Now, for the same reason, which is the multiple valuation model, which shows us the companies in the same sector and size we looked at, we will not also be using this model, just given that earnings per share, in my opinion, isn't one that is relevant or to use, just because over the last few years it has been significantly above that. But again, I will show you the value so you can effectively use this when you want to calculate it yourself. But it comes to $47.15, using the stock price earnings per share to get the average PE. Then we get the average PE here, multiplied by the earnings per share to get the stock price. So the first one that I will be using is the dividend discount model. We see the growth rate year on year average 8.85%. Now forward looking, I'm using 5.5%. As always, if you do grab a copy of the model and you want to play around and you believe it should be higher if you're more optimistic or more pessimistic lower, you can play around with these numbers. Gives a DDM price of $123, which as we can see shows around 23% upside to the current trading price, and it's slightly above that 52-week high, showing signs of undervaluation in the market currently. The second model that we're using is the DCF model, where we have the free cash flows year on year. Average growth at 23.6%. Now I have gone a lot more pessimistic at 7% below analyst targets, so more conservative, so do bear that in mind. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding to get a DCF price of 141, showing around 42% upside to the current trading price, and above that 52-week high that we've seen not too long ago. So the intrinsic value in this episode will just be the average of the two models that we have just run through. And again, if you do enjoy the content, value is being provided, do smash that like button, hit the subscribe and bell so you are continually notified of these videos as they drop. Now, margin of safety that we always start off with, 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. So it would be a buy up to $119. At 15%, it would be a buy up to $112, and at 20%, a buy up to $105. So right now, as we can see, roughly $1 shy, you are locking in a 25% margin of safety for Merck Co. Now, in terms of Wall Street and what they believe, well, they see some nice upside, slightly lower than the intrinsic value, but around 26% upside to the current trading price. So based on our estimates and judgments, you are locking in a 25% margin of safety for Merck Co, whilst also based on Wall Street analysts, looking at a 25% upside. As always, let me know your thoughts in the comments below, whether or not Merck Co is one that's on your radar, one that you have been recently buying, or if you've sold it, let us know the reasons. Finally, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. And as always, if you do enjoy the content, smash the like button, hit the subscribe and bell, and we will see you on the next episode. As always, have a great day and take care.